Hello, my name is Libu and my issue question was, to what extent can a liability be contested and deductible under Section 461F of the Internal Revenue Code, when the liability is incurred in the research and development of renewable energy resources that will not reach full development in the current tax year? As the natural resources that are not renewable, such as fossil fuels, are being used up, the need for renewable sources of energy will also increase. To invest in these areas now will allow companies a step ahead of most of their other competitors in the world market, and create competencies much earlier, and possibly even create a niche that can be protected against rivals. Many different groups, from environmental action groups to national governments, have been pushing for renewable resources that will allow us to be less dependent on non-renewable sources of energy. Some of the technologies involved in this area are solar energy, fuel cell technology, small wind turbines, geothermal energy, microturbines, and combined heat and power technology. Businesses, again, want to start investing in these areas because they can get federal tax credits for doing so, and because they can carve out a niche very early in the game. Now, there are many tax opportunities. There is the Business Energy Investment Tax Credit. There are tax credits for manufacturers of energy-efficient appliances. There are tax credits for builders of energy-efficient homes. And there's also the Renewable Electricity Production Tax Credit. These credits, again, allow interested companies to invest now in resources that could end up changing the world in which we live, and also allow themselves a chance to get some money from the government for research and development. Many environmental issues have driven the need for renewable energy resources. For example, the fact that fossil fuels create lots of pollution is a driving concern, especially as third world countries start developing automobiles for mass production without any kind of environmental standards. Not to mention the hole in the ozone layer, and of course the loss of our own natural resources and the after effects of pollution in our own lives. Solar power is currently the most well developed, with fossil fuels a close second. There are many companies that are trying to get into this new market. Established companies are buying upstart companies and using them to be cash cows for the energy business. There are many tax credits available now as well. Again, there is the Business Energy Investment Tax Credit. There are tax credits, again, for manufacturers of energy-efficient appliances, and again, energy-efficient tax credits for energy-efficient home builders. And also, again, the Renewable Electricity Production Tax Credit. Some of these credits, like the Business Investment Tax Credit, will cover up to 30% of all expenditures that are related to the renewable energy area. Now, what does 461F of the Internal Revenue Code say about research and development? Nothing. What does it say about liabilities incurred for research purposes? Again, nothing. What 461 covers is contested liabilities. In the area of contested liabilities, this section gives us the rules of what we must do when a liability is contested. This means that when the research and development activities in the area of renewable resources are considered liabilities by the government when they are not, the taxpayer can assert that this liability is contested, set aside money for the satisfaction of that liability, and then prove that, except in this current situation, in most cases, this liability would be a deduction as long as economic performance has occurred. Again, currently there is a 30% investment tax credit on expenditures for solar energy, fuel cell technology, and small wind turbines. There's also a 10% credit of expenditures for geothermal systems, microturbine technology, and combined heat and power technology. And as we see these fields becoming more well developed, we can expect to see contested liabilities becoming more and more a part of the U.S. tax system. Now, in what situations has the IRS actually denied liabilities incurred in research and development of renewable energy research? Well, and since this area is so new, there aren't cases yet where the IRS has actually denied anyone access to these tax credits. However, we can assume the basics. For example, claiming a tax credit for research and development when there is no actual research and development going on is the biggest example. Another example is combining research and development of renewable energy resources to other areas that are not related to that specific field. Is also considered an abuse. These tax credits, when used correctly, will be applied solely for research and development of renewable energy resources. That's the ideal situation. A less than ideal situation is when expenditures are bundled together from a common supplier and there's only one total bill. In that situation, what we would need is an item-by-item breakdown of what was purchased so that we can see what should be applied towards the tax credit and what should not be. Now, in the industries that are currently gaining ground, Solar power and fuel cell technologies are the ones that are taking the lead. Solar energy panels are very useful and have a lot of potential to provide alternate energy from something as simple as sunlight. An example of fuel cell technology is a Chevy Volt, which has a fuel cell and its own generator, which allows the car to have an unprecedented 230 miles per gallon. Now, as the need for renewable energy grows, the use of these credits and the contested liabilities that are related to them, again, will grow. Right now it's an emerging field, but in the near future we can expect to see renewable resources becoming a more viable option. Thanks for your time. If you have any questions, please feel free to post them on the discussion board and I'll be happy to answer them.